Evening everyone, hope you all are doing well. So today we are going to start consolidation IFRS 10 control accounting. Today we will cover basics of the consolidation as I am considering that you guys have never studied consolidation in your previous exam. This is the first time you are going to study the consolidation or group accounting. So that's why I will start from the scratch. This is the top 25 questions of the SBR, but I will not share this list with you guys right now. I will share this list after 1 week, means in the second week of the August, I will share this list. If any student need this list, you guys can comment down under this video. So I will share with those students who comment down and ask for this to top 25 questions and suggested plan. Let's move to the today's topic. Today is day 1 of IFRS 10 consolidation. Total 5 to 6 classes will be based on this topic consolidation, in which I will cover consolidation, equity accounting, consolidation, statement of financial position, statement of profit and loss, statement of cash flow, and we will also cover foreign subsidiary cases in this topic IFRS 10. Also, there is one more new standard IFRS 19 disclosure of group accounting, which will be covered in this series. So this is day 1 IFRS 10 consolidation. IFRS 10 consolidation means when an entity is going to acquire 50% or more shares of another company. Let's say there is a P company, parent company is going to acquire 50% or more than 50% shares of S company, the subsidiary company. So now P company is the holding company and S company is the subsidiary company. Once the P company acquired the S company, from that date, from this date, this is called acquisition date. From this acquisition date, the accounting will be performed as per IFRS 10 group accounting or consolidation accounting. We will solve few questions, basic questions on this acquisition or on this merger. Now, consolidation. When one company acquires another company, it acquires the net assets of that company. We will cover what are net assets. Normally, control comes with 50% plus shares, but sometimes control can be obtained with less than 50% shares. We will cover what are those factors in which control can be obtained by P company over S company when the shareholding is less than 50% in the latter section. Point number 3 is P company buys running business of S company. That's why it pays for the goodwill. Why we calculate the goodwill? Because P company buys the running business. Of course, this is the business of the S company, which S company is generating revenue from that business. So this is a running business. P company buys running business of S company. That's why pays goodwill. Consolidation is the responsibility of the parent company, because parent company is the holding company and parent company is going to acquire the shareholding of S company. This is why the responsibility for the group accounting is with P company. When we do group accounting consolidation, we treat complete group as a single entity. That's why there are few transactions which we call intra-group transactions. As per IFRS 10 consolidation or group accounting, any transaction between the group members will not be considered as an actual sale. We will cover few transactions in today's lecture. Goodwill is calculated at the date of acquisition, means when parent company acquire S company, this is called acquisition date, and at this date, all the fair value of net assets will be taken in the calculation of the goodwill. Goodwill is calculated at the date of acquisition. That's why we always use acquisition date net assets of S company in the goodwill calculation. Let's go through example number 1. Let's say P company acquired 80% of S company on 1st Jan 2001 at 60,000. This is your cost of investment. The opening retained earning of S company is 20,000. P company retained earning is 25,000. This is the individual balances of both the entities, P company and S company. Now we are going to solve for the consolidation for the group accounting. Remember the steps. Step number 1 is when the acquisition is happen. So how you have to perform this step? You have to make a table like this at acquisition date, at reporting date, and the third column will be the net, means the difference between the reporting date and acquisition date. Other share capital, these are the subsidiary figures. I am again repeating, parent company is going to acquire the S company. So these steps performed on the S company figures. So you will have to take in the other share capital of S company at the acquisition date and at the reporting date. If there is a share premium, then you will have to take in the share premium as well. Now retained earning, as the opening retained earning is given by the examiner in the first line, which is 20,000. So you write 20,000 at the acquisition date and 50,000 is the reporting date retained earning. Let's assume this is mentioned in the question. Net assets of S company is 40,000, 10 plus 10 plus 20 is 40,000 at acquisition date. And net assets of subsidiary company at reporting date is 70,000. 50 plus 20 is 70,000. The difference between acquisition date and reporting date balance is 30,000. This is called net reporting balance, or you can also write net balance. We will know whether and how this net balance will be incorporated in the later steps. Step number 2 should be goodwill calculation. In this example, we are going to solve or calculate goodwill based on proportionate method. I will tell you the difference between proportionate method. There are two methods in calculating the goodwill: proportionate method and full goodwill method, also called fair value method. Proportionate method, in which there is no component of NCI. NCI means non-controlling interest. If you remember, P company acquired 80% of S company. So of course there is 20% remaining. So 20% is the NCI shareholding. In case of proportionate method, no component of NCI is taken in the goodwill calculation. Cost of investment is 60,000 as it's given in the question. Fair value of net assets of S company at acquisition date. Remember, goodwill is calculated at the date of acquisition. So net assets of S company at the acquisition date is 40,000 and the share of P company is 80%. So 80% multiplied by 40,000 is 32,000. 60 minus 32,000 is 28,000, which is your goodwill, which will be reported in the consolidated statement of financial position. Now, step number 3, NCI calculation. NCI will be reported in the consolidated statement of financial position under the reserve, liability or equity side. So, proportionate 20%, 80% we incorporate in the goodwill. Now NCI is the 20%. Why 20%? Because the 80% is acquired by the parent company. How to calculate the NCI value? S company, subsidiary company net assets at acquisition date of NCI percentage. NCI percentage is 20%. So 20 multiplied by 40,000 gives you the 8,000, in which you have to include the net reporting date balance, and the net reporting date balance is 30,000. You can also call it post retained earning. So you have to add 6,000. How 6,000? 20% is the NCI share and the net reporting or retained earning balance is 30,000. So 0.2 multiplied by 30,000 is 6,000. The total is 14,000. This is the NCI balance, which will be reported in the consolidated statement of financial position under the equity or liability side. Now, step number 4 is the last step, which is the consolidated reserve, consolidated retained earning. What you guys call it? You can call consolidated retained earning or consolidated reserve. You have to take the parent company retained earning, which is given in the equation is 25,000, in which you have to include the S company post retained earning. 20% you have incurred here. Now 80% will be incorporated here. So the total is 49. Again, this will be included in the consolidated statement of financial position under the equity side because this is the reserve. Now let's solve one question in which we will also make the consolidated statement of financial position as well. Question number 1, A company acquired 70% of B company for 45,000. This is the cost of investment consideration on 1st January 2007. At date time, retained earning of S company means on the acquisition date, opening retained earning is 10,000. A company SOFP at 31st December 2008 and B company's SOFP at 31st December 2008. So this is the SOFP of A company and this is the SOFP of B company, subsidiary company. This is parent company, this is subsidiary company. Now, fair value of NCI at acquisition was 20,000. If you recall, in the previous question, there were no fair value of NCI. And in that question, means in the previous question, we used or we solved the goodwill with the proportionate method. But in this question, there is a fair value of NCI. So we will calculate goodwill on full goodwill method, on fair value method. Required consolidated SOFP at 31st December 2009. Let's solve this question. Again, step number 1, at acquisition date column, at reporting date column, and net balances. Ordinary share capital 20,000 and 20,000. You have to input the subsidiary figures, okay, at the acquisition date and at the reporting date. Here, no premium, so you did not need to write any premium balances. Now, subsidiary next balance is retained earning. So, retained earning you have written here, and at the acquisition, at the time of acquisition, the retained earning was 10,000. So you have entered in the acquisition column 10,000, and at the reporting date, the retained earning is 30,000. The difference is 20,000. Net assets of S company is total 30,000 at acquisition, and at the reporting, it's 50,000. The difference is 20, which is due to retained earning. Now, step number 2, full goodwill method. Please, guys, be attentive, be attentive. We are going to solve the goodwill with the full goodwill method. Cost of investment, same in both the method. We use the cost of investment. Now, fair value of NCI at acquisition date is 20,000, which is given in the question. In the proportionate goodwill, there was no fair value of NCI. Even if it's mentioned in the question fair value of NCI at acquisition date, but the examiner asked you to calculate the goodwill on proportionate method, then again you don't need to take this fair value of NCI at acquisition date because this will be the trap for you. Now, in the proportionate goodwill, we also consider the fair value of net assets of S company at acquisition date. But in the proportionate goodwill, we only incorporate the parent company percentage. But in full goodwill, we took the entire net assets of S company balance at acquisition date. Look, this is 30,000. Complete 30,000 have been deducted. The balance is 35,000, which is your goodwill. If you guys have not understand the difference between these two, you guys can communicate me after this lecture. I will try to explain each and every one whatever things make difficult for you. So don't worry about these things. You guys can communicate me anytime. Step number 3, NCI calculation. In this case, NCI holding is 30%. Fair value of NCI at acquisition date is given, which is 20,000. But in the previous question, in the proportionate method, we took the NCI value of the S company net assets at acquisition date. Here, fair value of NCI is given, so we took the fair value of NCI. Again, add post-retained earning. This is at 30%. 30% of this balance is 6,000, so the total value of NCI is 26,000. Now, step number 4, consolidated retained earning or reserve. P company retained earning mentioned in the question, which is 20,000. Here it is mentioned. Look this one. So this is 20,000. Now, S company post retained earnings, net balance 20,000 was the net balance. P company share is 70%, so 70 multiplied by 20, 14,000. The total value of consolidated reserve is 34,000. Let's make an SOFP, consolidated statement of financial position. Non-current assets, goodwill, current assets, non-current assets and current assets given in the question. Goodwill we just calculate in step 2, which is 35,000. Equity mentioned in the question of the parent company. Why not subsidiary company? Because the subsidiary company's equity and premium impact has been taken here. We have taken the subsidiary company share capital here, and based on that we got a difference, and this difference is incorporated in NCI and consolidated reserve. So we do not need to include the equity of subsidiary company. This is the equity of parent company. Look this one, 50,000. Again, we do not need to include the retained earning of parent company and subsidiary company in the consolidated statement of financial position. Why? Because these figures have been incorporated in step 4. So we write CRE, consolidated retained earning or reserve, 34,000 be calculated in the step 4. NCI we calculated in the step 3, 26,000. Now liabilities. How liabilities are 60,000? Let me calculate you for. Liabilities for the P company is 50,000. Liabilities for the S company is 10,000. So the total liabilities are 60,000, which we just written in the consolidated statement of financial position. Now current assets are 55 and non-current assets are 80. How? Wait, let me show you each and everything. Non-current assets of P company is 50 and B is 30. So the total is 80, which is written in the consolidated statement of financial position. Current assets are 25 for P company and 30 for the B company, means subsidiary company. So the total is 55, which just entered in the consolidated statement of financial position. These are the basic principles or the basic examples which I have selected for you so that your base might get more strong. If you guys still have any doubts or any confusion, please feel free to contact me anytime. Anytime. There is no restriction from my side. You guys can ask question anytime. Okay. Now, move to the why do we use two methods for goodwill. This is for your better clarity or your better understanding. Because IFRS 3 we will cover once we move to the later stage. IFRS 3 business combination gives entities a choice in how to measure non-controlling interest. After that, affects how goodwill is calculated. The two methods, full goodwill method and proportionate partial goodwill method, measures 100% of goodwill even if the parent owns less than 100%. NCI is measured at fair value, what the market says the NCI is worth. Results in higher goodwill on the consolidation balance sheet. You can compare the goodwill of both the methods. Used when the group wants to show the total value of the acquired business, including the part it didn't buy. In the second case, group buy 70%, 30% not buy, but shows the total value of the acquired business. That's why I adopted full goodwill method. In most of your past paper exam, the examiner asked for the Full goodwill method. Proportionate partial goodwill method measures goodwill only on the parent's share of subsidiary, no shares of NCI. NCI is measured as their share of net assets only, not including goodwill, only incorporated in the NCI value, not for the goodwill. Results in lower goodwill and lower total equity. Used when entity wants to show only the value it controls and not overstate the goodwill. Why the choice exists? Exam insight, faithful representation, practicality, accounting policy choice. In the exam, SBR may ask to calculate goodwill using both methods. It's very rare nowadays. To discuss the implications of choosing one method over another. Example there is for you. Now move to the later stage. This is very, very important. Maybe some of you know might not be able to understand these transactions, but I will try my best to explain each and everything in proper detail along with practical examples. Let's start the intra-company transactions. Intra-company or intra-group transactions mean transactions between the group members from subsidiary to parent or from parent to subsidiary. Let's read transaction number one. Parent to subsidiary sales of inventory means parent company sales inventory to subsidiary company. Let's read. P company bought goods at $200. This is the cost. And sell it to S company. Now they are selling to another member of the group, which is subsidiary company at 500. So of course there is a gain or there is a profit of 300. S company did not sell it to anyone, means the inventory is still held by the S company. Therefore, there is an unrealized profit of 300. 500 minus 200 is the 300 profit. So this should be removed from the inventory. This is the treatment. This should be removed from the inventory in the consolidated books, as from the group point of view. This is not an actual sale. Why? Because this is between the group members. Just assume that you have a glass of water from your right side and you took this glass of water and place it on the left side. So it means the water is still there. It's not like you transfer or you pass this water to the next person and the next person has drink it. Now, what is the treatment in this case? This line means from the inventory in the consolidated books you have to remove, means let me show you again. Look there. You all know inventory is the part of current assets. So from this current asset, you have to deduct this inventory and balance. 55,000 minus whatever the inventory amount is, you have to deduct it from there. Now, what is the treatment? This unrealized profit, this URP, should be deducted from the consolidated reserve. Consolidated reserve, step number 4. Look how I have mentioned even the steps. So if any new student or any newbie or any freshie might start reading or understanding this topic from this note, so you guys can better understand it. From the consolidated reserve and the group inventory in consolidated SOFP, don't worry, we will solve questions on each and everything. Once we move to the next stage, there are more questions we will solve. Even consolidations, I will solve so many questions. Don't worry, consolidation is not about giving you the concepts and go on. It's all about the practice. It's all about doing questions. So we will solve so many questions. Don't worry, these are just the basic class, basic examples, basic concept class. Now, transaction number 2, subsidiary to parent sales of inventory. In this case, subsidiary company is selling inventory to parent company, to P company. S company bought goods at 200 and sell it to P company at 500, but P company did not sell it to anyone. Therefore, there is an unrealized profit of 300. I took the example from transaction number 1 and just shift it. So this should be removed from the inventory in the consolidated book. It is mandatory that any transactions made between the group members should be deducted or removed from the consolidated financial position. We are just covering the SOFP, so don't get confused why there is no treatment on SOFPL. Once we move to the SOPL or SOCF, we will learn the treatment in that topics. Okay. Now, what is the treatment? This unrealized profit should be deducted from the S company's reporting date net assets. There is a little change in the P2SL, the amount, the balance deducted from the consolidated reserve. Why from the consolidated reserve, and why in this case it's deducted from the S company's reporting date net asset? Step 1. Remember the step 1 at acquisition date, at reporting date, and the group inventory in consolidated SOFP. These for the inventory. Now, transaction number 3 for the non-current assets, fixed asset. It could be intangible, could be PPE. P company bought asset at $200 and sell it to S company at 500. Therefore, there is an unrealized profit of 300. So this should be removed from the non-current asset in the consolidated books. Remember, we just solved one questions. From the non-current assets in consolidated books, as from the group point of view, this is not an actual sale. If you watched my IAS 12 income tax lecture, in which I have explained the treatment of these cases, they are also treatment. This unrealized profit should be deducted. This URP should be deducted from the consolidated reserve, and the group fixed assets in consolidated SOFP means from the consolidated reserve it should be deducted, and from the group fixed asset in the consolidated SOFP, and then an adjustment of extra depreciation in S company book. What is this? Don't worry, we have an example on this extra depreciation. Just wait a minute. Now, what if the subsidiary to parent sales of non-current assets? Again, S company bought asset at 200 and sell it to P company at 500. Therefore, there is an unrealized profit of 300. So this should be removed from the NCA in the consolidated books. As from the group point of view, this is not an actual sale treatment. This URP should be deducted from the S company reporting date. Look, when S is going to sell P, the treatment is same. You can compare this treatment. Oh my God. Wait a minute. Yeah, you can compare this treatment with this treatment. So the unrealized profit should be deducted from the S company reporting date net assets, step 1, and the group fixed asset in consolidated SOFP, and then an adjustment of extra depreciation in P company book. In P company book, in the transaction number 3, adjustment made in the S company book, but now this is S2P sale, so the extra depreciation adjustment should be made in P company book. Let's solve an example for the adjustment of extra depreciation. P company sold asset to S company at 1500, whereas the net book value is 1000 and life is 10 years. The unrealized profit is 500. How 500? 1000 is the cost and 1500 is the selling price. So difference is 500, which is URP. This should be deducted from the consolidated retained earning step 4 and the group non-current assets in SOFP, consolidated statement of financial position. Now, the asset is in S company books. The asset is in S company books because the asset is acquired by or purchased by S company from P company. So the asset is in S company books, and S company charged depreciation of $150. How 150? 1500 is the price, divided by 10 is 150. But from the group point of view, this is not an actual sale, and the group charged depreciation over the original price, which is 1000. So based on 1000, the depreciation which group charge is 100. So of course there is a difference of 50, which is the extra depreciation. You can also calculate this extra depreciation by just dividing the URP with the life of the asset. Life is 10, so 500 divided by 10 is 50. This is the extra depreciation. Therefore, the extra depreciation of $50, 150 minus 100, will be added in S company reporting net assets and group plant. If it relates to plant, so add in plant. If it relates to building, add in building. If it relates to vehicle, add in vehicle. Now you guys can understand the treatment of extra depreciation. Whenever there is extra depreciation in case of T2S cell, that extra depreciation will be added in S company reporting net assets. Reporting net assets, S company reporting net assets, S company reporting net assets means S company reporting net assets means here you have to write URP. There will be dash, you can enter dash, then the balance of depreciation will be right down here. Hope you are getting the things. If you are not getting it, please try to communicate. Okay, now different types of consideration. It is not mandatory or necessary that the parent company, that the investor always pay in cash. What if investor pays or P company pays in cash? So the entry is investment debit cash credit. If pays in shares, now you guys can identify or understand why I have not discussed this topic previously, because there are so many standards IAS, IFRS, which you don't know before this. So you can't solve IFRS 10 consolidated questions. Investment debit, ordinary share capital, credit and share premium, credit ordinary share capital recorded at par value multiplied by face value. Loan note consideration, if the investor given a loan note, so investment debit, loan note credit. Now if the investor gives a fixed asset as a consideration, investment debit at fair value, land at carrying value, the difference will be either gain or loss, which will be reported in P&L. If the investor or parent company gives deferred consideration means unconditional promise to pay. What will be the entry? Investment debit, deferred consideration debit. Deferred means in the future, of course there will be an interest. The interest expense or consolidated retained earning or reserve is debit. Deferred consideration credit. Make sure you guys are getting the things. Whenever there is any impact on P&L, it should be included in the consolidated retained earning, because we all know retained earning is the component, or it's not wrong to say profit is the component of the retained earnings. So anything affecting the profit will have a trickle down impact on the retained earning. So that's why if there is any entry which is the item of P&L, should have a trickle down impact on the consolidated retained earning. That's why consolidated retained earning debit and deferred consideration credit, purchase at 1st Jan 2001 and payment at 31st December 2001. future date Future date value is 1100. You have to calculate the present value to make this entry. Present value is 1000. Investment debit 1000, deferred consideration credit 1000. There is a 10% interest. 10% multiplied by 1000 is 100. Interest expense, consolidated reserve debit 100, deferred consideration credit 100. If you add both the deferred consideration balance, you will arrive at this closing balance or the 31st December balance, which is 1100. What if the investor pays the contingent consideration? Contingent means conditional promise to pay, whereas deferred means unconditional. Please be attentive. Open your eyes, your ears, whatever you have, please open it. Contingent consideration, conditional promise to pay cash. This has been tested many times. Examiner loves this type of consideration. Trust me, once we start solving the equations, almost in every question there is a contingent consideration. Be attentive. Contingent consideration must always be recorded at fair value at acquisition date. Contingent consideration transferred on a business combination is recognized in the financial statement, regardless of the level of probability chances of default. Instead, the fair value is adjusted to reflect the level of uncertainty of the contingent consideration, means the conditional uncertainty. Three cases. If P company, parent company, promised to pay cash to S company, this is a liability. If P company promised to deliver variable number of its own shares to S company in future, again, this will be the liability. If P company promised to deliver fixed number of shares, then it will be considered as equity from day one, means from the day of acquisition. Why in case of variable number share it's liability? Because there is an uncertainty. We do not know about this. So the entry in case of equity investment debit, contingent consideration credit. If there is an equity, we all know if there is a change in contingent consideration fair value, we do not made any entry for this change. Now, if contingent consideration is treated as a liability, means upper two cases, then first it will be recorded at fair value at the acquisition date, and then it will be revised in future with changes in fair value taken to consolidated reserve. In the consolidation, we use consolidated reserve instead of P&L. Okay, guys. Fair value of contingent consideration liability at 1st Jan 2001 is $1,000, and at 31st December 2001, the fair value is 1100. The change is 1,000 recorded in P&L slash consolidated reserve. Entry investment debit contingent consideration credit by 1,000. Now P&L CR debit and contingent consideration credit by 100. This change entry is only made in case of liability. Now, what if contingent consideration is treated as an equity? Then it will be recorded at fair value at the acquisition date, and it will not be revised in future. Fair value of contingent consideration equity at 1st Jan 2001 is 1,000, and at 31st December the fair value is 1100. The change of 100 is not recorded in case of equity. Make sure you guys are getting these things. Investment debit only by 1,000, contingent consideration by 1,000. No more entry for this change. Now, this is extracted from the past paper. Goodwill is calculated at the acquisition date. You all know. Now, but you don't know this thing. I know you don't know this thing. At the date when control retained. Now, if any further shares purchased after this, means after the acquisition date, let's say parent company acquired 80% shares. At the acquisition date, you calculated the goodwill. Now, after few days or few months, parent company is going to acquire another 10% or 5% shares of subsidiary company. What do you think? Will you revive your goodwill value? No, you do not need to revise. Why? Because we have studied so many times that goodwill is calculated at the date of acquisition. After that, any additional or further purchase or acquisition of shares will not be incorporated in goodwill. This is written in red. You better study it. Now there are few terms which we will continue further in tomorrow's class. Let me give you an overview. Control when more than 50% subsidiary shares acquired. Adding together accounting means consolidated accounting. Significant influence when more than 20% but less than 50% shares acquired. In that case, you have to do the equity accounting. If you have watched my IFRS 11 joint arrangement lecture, then you have an idea. Trade investment, if you have watched my previous lecture, I have invested 4 to 4.5 hours on IFRS 9. then you might have an idea of the trade investment. If trade investment less than 20% shares, use IFRS 9, because this is the equity recorded at either fair value through P&L, which is the default category. From fair value to PNL to fair value through OCI, you need an election, you need a permission. But once you move to the fair value through OCI, from fair value to PNL, then there is no option to reverse back. So make sure before classifying your equity investment. That's it for today's class. Again, I am repeating. If you have any questions or any confusion, please feel free to reach out to me. Okay, if any student want these top 25 PDF, you guys can comment down under this video. I will try to share a link with you guys. Take care and good luck. Best wishes for your exam.